Let me ask you something. How many years did you spend in school? 12? 16? Maybe more if you went the grad school route. And in all those years, all those thousands of hours sitting in classrooms, how many of them were dedicated to teaching you how money actually works? For most of us, the answer is 0. We learned the mitochondria is the powerhouse of the cell, but nobody mentioned the credit card interest could quietly devour your paycheck. Surveys consistently show that fewer than half of adults in the United States can answer basic financial questions correctly. We're talking about things like how compound interest works, or what inflation does to your savings over time. These aren't trick questions, they're the fundamentals of the system we all live inside. And yet, here we are, collectively winging it. So today, we're fixing that. Consider this your 15-minute crash course in the stuff that actually determines whether you thrive or just survive financially. Let's start with something most people avoid, like a dentist appointment. Figuring out where you actually stand. Your net worth is the simplest snapshot of your financial health. Add up everything you own, your savings, investments, the value of your car, whatever's in your retirement accounts, and subtract everything you owe. Student loans, credit card balances, your mortgage, all of it. The number that's left is your net worth. And look, if that number is negative right now, don't panic. Plenty of people start there, especially right out of school. What matters is the direction it's moving. Next, look at your cash flow, the gap between what comes in and what goes out each month. If more is leaving than arriving, you've got a leak, and no amount of investing advice will help until you patch it. Finally, think about your financial runway. If your income disappeared tomorrow, layoff, illness, surprise career change, how many months could you keep the lights on? That number is going to matter a lot more than you think. Now, most financial advice jumps straight into budgets and savings rates, and that's fine. But it skips the most important step, figuring out what you actually want. Money is a tool. If you don't know what you're building, having a hammer doesn't help much. So before we talk tactics, think about your life goals. Maybe you want to travel for a year. Maybe you want to start a business, or retire at 55, or just stop losing sleep over bills. Whatever it is, write it down. Then work backwards. If you want to retire at 55 with a comfortable lifestyle, how much do you need invested by then? If you want to buy a house in 5 years, what does that down payment look like? And how much do you need to save each month to get there? This is where the SMART framework earns its keep. Goals that are specific, measurable, achievable, relevant, and time-bound. I want to be rich is a wish. I want to save $40,000 for a house down payment in 4 years by putting $850 a month into a high-yield savings account is a plan. Break your goals into short-term, things in the next year or two, medium-term, say 3 to 10 years out, and long-term, which is everything beyond that. Each horizon has different rules for how you should handle the money, and we'll get to that. All right, budgeting. I know. The word itself feels like putting on a financial straitjacket. But here's the truth. A budget isn't about restriction. It's about intention. You're deciding in advance where your money goes instead of wondering where it went. The most popular starting framework is the 50-30-20 rule. 50% of your after-tax income goes to needs: rent, groceries, insurance, minimum debt payments. 30% goes to wants: dining out, subscriptions, hobbies, that suspiciously expensive coffee habit. And 20% goes to savings and extra debt payments. It's a solid baseline, but it's not gospel. If you're drowning in debt, maybe that 20% needs to be 30 for a while. If you live somewhere with absurd rent, your needs category might eat more than 50. Adjust to your reality. For people who want more control, there's zero-based budgeting, where every single dollar gets assigned a job before the month starts. Income, minus all planned spending equals zero. Nothing floats around unaccounted for. It's more hands-on, but it's incredibly effective for people who feel like money just evaporates. Then there's the envelope method. Old school, but it works. You set cash limits for categories like groceries, entertainment, and dining out. When the envelope is empty, you're done for the month. You can do this digitally now with apps, but the principle is the same. A hard boundary that keeps you honest. One thing that trips people up is irregular expenses. Your car registration, holiday gifts, that annual insurance premium. These aren't surprises, they happen every year. The trick is to add them all up, divide by 12, and set aside that amount monthly in a sinking fund. When December rolls around and you need to buy gifts, the money is already sitting there waiting. No credit card required. The key to any budget is sustainability. If your system makes you miserable, you'll abandon it by February. Find one that fits your personality. Automate what you can, and give yourself permission to spend guilt-free on the things you've budgeted for. That's the whole point. Let's talk about saving, starting with the single most important financial buffer you can build, an emergency fund. This is money you don't invest, don't touch for vacations, and definitely don't use to buy things on sale. It sits there, boring and accessible, waiting for the day your transmission dies or you get laid off. The standard advice is 3 to 6 months of essential expenses, but your number depends on your situation. If you're a freelancer or work in a volatile industry, 6 months is the floor. Aim for more. If you have a stable government job with good benefits, 3 months might be plenty. Where you keep this money matters. A regular checking account pays you essentially nothing. A high-yield savings account, on the other hand, will at least let your emergency fund grow a little while it waits. Money market accounts are another solid option. Slightly different structure, similar returns. The point is that your emergency fund should be liquid, meaning you can access it quickly, but not so accessible that you accidentally spend it on a weekend trip. Keep it in a separate bank if you have to. Out of sight, slightly out of mind. Now, debt. Not all debt is created equal, and understanding the difference can save you years of stress. A mortgage at a low fixed rate on a property that appreciates? That's leverage. It's working for you. A credit card balance at 22% interest on stuff you can't even remember buying? That's a financial emergency. The two most popular payoff strategies are the snowball and the avalanche. With the snowball method, you pay minimums on everything and throw all your extra cash at the smallest balance first. When that's gone, you roll that payment into the next smallest, and so on. It's not mathematically optimal, but it's psychologically powerful. Those early wins build momentum. The avalanche method targets the highest interest rate first, regardless of balance size. This saves you the most money over time, but it can feel slow if your highest rate debt also has a big balance. Honestly, the best method is whichever one you'll actually stick with. If you've got student loans, look into whether income-driven repayment plans or refinancing make sense for your situation. And for car loans, well, we'll get to cars in a minute, but the short version is, the less you borrow for a depreciating asset, the better. All right, investing. This is where your money stops working a day job and starts building wealth in its sleep. The single most powerful concept in all of finance is compound interest. Here's a quick illustration. If you invest $300 a month starting at age 25 and you earn an average return of 8% annually, by 65, you'd have roughly $860,000. But if you wait until 35 to start, just 10 years later, you'd end up with around $370,000. Same monthly contribution, same return, but starting a decade later costs you nearly $500,000. That's not a typo. That's compounding. So where do you actually put this money? For most people, the answer is broad market index funds. These are funds that track the overall stock market. Essentially, you're buying a tiny piece of thousands of companies at once. They're cheap, diversified, and over long periods, they've consistently outperformed the majority of professional stock pickers. You don't need to analyze earnings reports or follow market news. You just contribute regularly and let time do the heavy lifting. This strategy is called dollar-cost averaging. You invest a fixed amount on a regular schedule, regardless of whether the market is up, down, or sideways. When prices drop, your fixed amount buys more shares. When prices rise, you buy fewer. Over time, this smooths out the bumps and removes the temptation to time the market, which, by the way, almost nobody does successfully on a consistent basis. And about market crashes. They're going to happen. They've always happened. The market dropped nearly 34% in about a month during early 2020. It recovered within 5 months. If you panicked and sold at the bottom, you locked in those losses permanently. If you stayed the course, or better yet, kept buying, you came out ahead. The lesson is simple but difficult. When markets crash, do nothing. Or do more. For retirement specifically, take advantage of tax-advantaged accounts. If your employer offers a 401k with a match, contribute at least enough to get the full match. It's literally free money. Beyond that, consider a Roth IRA, where you contribute after-tax dollars, but your money grows and comes out completely tax-free in retirement. If you earn too much for a Roth, a traditional IRA gives you a tax deduction now, but you'll pay taxes on withdrawals later. The best choice depends on whether you think you'll be in a higher or lower tax bracket in retirement. But honestly, having a mix of both gives you the most flexibility. Let's talk about one of the biggest financial decisions most people face: buying versus renting a home. The internet is full of people screaming that renting is throwing money away. It's not. Renting is paying for a place to live, just like buying is paying a bank interest for the privilege of slowly owning a place to live. When you buy, you're also paying property taxes, homeowners insurance, maintenance, repairs, and closing costs. The rule of thumb used to be, buy if you'll stay for 5 years. But the real math is more nuanced. Run a break-even analysis. Compare the total cost of owning, mortgage interest, taxes, insurance, maintenance, opportunity cost of your down payment, against the total cost of renting and investing the difference. In expensive markets, renting and investing often wins for years or even decades. In cheaper markets, buying can make sense much sooner. The point is, don't let social pressure push you into a financial commitment that doesn't make sense for your situation. Homeownership is great when the numbers work. It's a disaster when they don't. And while we're on expensive purchases, let's talk cars. Most people dramatically underestimate what a car actually costs. It's not just the sticker price or the monthly payment. Factor in insurance, fuel, maintenance, registration, depreciation, and interest on the loan, and the average car in America costs somewhere around $9,000 to $10,000 a year to own and operate. A new car loses roughly 20 to 30% of its value in the first 2 years alone. That means if you buy a $35,000 vehicle brand new, you've lost somewhere in the ballpark of 8 to 10 grand before you've even gotten your second oil change. The financially optimal move? Buy a reliable used car that's 2 to 4 years old. Someone else has already absorbed the worst of the depreciation, and pay cash if you can. If you can't pay cash, put down as much as possible and keep the loan term short. A 72-month car loan might have an appealing monthly payment, but you'll be underwater on that vehicle for years, meaning you owe more than it's worth. Now, retirement planning. We touched on the accounts earlier, but let's talk about the actual math. A common benchmark is to aim for roughly 25 times your annual expenses saved by retirement. So, if you spend $50,000 a year, you'd want about $1.25 million. This is based on the 4% rule, the idea that you can withdraw 4% of your portfolio annually and have a strong probability of not running out of money over 30 years. Is it perfect? No, but it's a solid starting point. The single most important variable in this equation isn't how much you invest or even your rate of return. It's when you start. Every year you delay is a year of compounding you'll never get back. If the math feels overwhelming, just start somewhere. Even $50 a month is infinitely better than zero. And automate it. Set up automatic transfers to your investment accounts on payday so the money moves before you even see it. You can't spend what you never touch. Which brings us to the final piece: action steps. Everything we've covered today is useless if it stays theoretical. So here's what I'd suggest. First, automate everything you possibly can. Savings contributions, investment transfers, bill payments. Take your willpower out of the equation. Second, check in on your finances once a month. Not obsessively, not daily, just a brief review to make sure the ship is pointed in the right direction. Third, be patient. Building wealth is boring. It's supposed to be boring. The exciting financial strategies are usually the ones that blow up in your face. Consistency, time, and discipline will beat cleverness every single time. You didn't get a financial education in school. That's not your fault. But from this point forward, what you do with this information is entirely on you. You now know more about personal finance than the majority of adults walking around out there. The question is whether you'll act on it. Start small if you need to. Start messy if you need to. Just start. Future you is counting on it.